Trends have a tendency to recycle themselves, repeating every 10, 20, 30 years over and over. Look at fashion, history, movies, music. I mean, look at the way that vinyl has made such a huge comeback. But what about financial markets? Are we doomed to repeat past trends, or do we always say, this time it's different? We're going to talk about that question right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thanks so much for being with us. I'm excited to welcome to the studio Richard Bernstein, CEO and CIO of Richard Bernstein Advisors, or RBA. Rich, great to have you here in the studio with me.
Thank you. Great to be here.
Welcome. I read a recent white paper of yours called Something's Gotta Give, where the question was, again, are we in a pattern of cyclical, or is this a different perspective, a different time? So, you know, we have seen over and over again, and certainly you in your career, and you've seen financial cycles do have repeats. They have, you know, you can sort of speculate, but eventually you'll see cyclicalities in there. But this time it feels that it's different. We're coming off of a global pandemic. Markets, this inflation that we're seeing is, you know, unprecedented, which is a word that's overused, as you said to me. Is it new, or are we just repeating cycles from the past?
So, Anthony, I think when people say this time is different, they're basically arguing that economic relationships don't hold anymore. And there's certain ones that are just embedded in the economy, embedded in the financial markets, and they do repeat again and again and again. And they're kind of the rules of the game, if you will. Right now, we have a situation where people do think this time is different, and we think that that's probably not right.
Why? Why do you think that? And here's why I say that. Every time we sit down and we're answering questions or asking questions of our guests, we're asking questions that I feel are slightly different. We're looking at, you know, treasury rates. We hit 5% on the 10-year last October of 2023, which was an all-time high. It feels different. Why do you say that it's not?
Well, even the case that you mentioned there, Anthony, that if you look back and you'd say, what was nominal GDP, real GDP plus inflation, and if you look at what nominal GDP was historically and what the 10-year was yielding historically when you had nominal GDP roughly at that level, guess what? It was 5%. So again, you know, the notion that this time is different is really a dangerous notion. I think very often people say that because they don't have a good sense of financial history more than anything else.
Yeah, you made a really good point as we were preparing for this, that the reason why they teach you history in school is so that you can kind of understand that history also repeats itself.
Correct.
World history, we look at wars and we look at conflicts, and you can go back generations and it feels like there's some sameness there. And the same can be said, as you, for financial markets.
Absolutely. I mean, one of the first jobs I ever had on Wall Street, my boss told me to just go off and learn everything I can about the history of the S&P 500. When were its highs, when were its lows, what were earnings doing, what were interest rates doing? And I thought it was kind of, you know, boring stuff, but in fact, it was like taking ground balls in spring training. You got to do the fundamentals before you start trying to hit.
Yeah. So something that you wrote about in the white paper is you kind of gave a couple of different explanations for why this time looks different, but as you said, it's not really. And one of them was you talked about this large cap bubble, the Magnificent Seven, or you called it a bubble in the paper. Is it a bubble? Do you think that what's happening in stocks, especially on the large cap side, is a bubble, or is there fundamentalness behind? I mean, we've seen decent earnings.
Right. So here's the way I would describe it. Nobody's saying the Magnificent Seven are not good companies. They're fine companies. I think the question is, are they unique? So that we should have narrow leadership. I mean, there's been lots of studies that show that the leadership in the equity market right now is the narrowest since the Great Depression. Now, in the Great Depression, you could understand narrow leadership. You could say, look, companies are going bankrupt right and left. The economy's in terrible shape. There's a few companies that are surviving and thriving within a depression. Narrow leadership makes perfect sense. That's not what's going on today. The economy's perfectly healthy. We had a mild profit recession, but now we're coming out of that. And right now, there are about 160, 170 companies in the United States alone that are growing earnings 25% or more. So when you're getting that kind of breadth of improving fundamentals, why would you have a narrow market? It's not the Depression. And I think that's a huge difference. We could argue whether it's speculative, a bubble, or just not following fundamentals. That's sort of like how many angels dance on the head of a pin. Who cares? But there's something very odd going on here that is not fundamentally based.
You also talk about credit spreads on the fixed income side and looking at high yield bonds, junk bonds, and their recent performance, what do you see in that might be an explanation for what we're experiencing?
So what's very, very odd right now is that we've got large cap stocks outperforming small cap stocks at the same time that junk bonds, high yield bonds, are outperforming quality. Normally they go hand in hand. Junk equity and junk bonds are influenced by the exact same factors: corporate cash flows, what's going activity in the economy, everything else. And so what you will find historically is that when junk bonds are outperforming quality, junk stock, usually smaller capitalization stocks, are outperforming large cap stocks. And that goes on for decades. Right now it's not. We have large cap stocks outperforming and junk bonds outperforming.
What's happening there?
So we kind of say there's three possible explanations. Okay, explanation number one is that the large cap stocks are in a bubble, that the Magnificent Seven is a bubble, or at least some kind of hugely speculative period, that the junk bond market has it right, that corporate cash flows are improving, that corporate profits are accelerating, and credit spreads should be narrow. It's the narrowness of the stock market that doesn't make any fundamental sense.
Right.
Number two, you could say the equity market's right, that this narrow leadership is justified. That really would argue that we're going to have one heck of a credit event coming forward. I don't think one could argue that maybe credit isn't what it should be. I get that. But we're not having a credit event like we had in the Great Depression or anything close to that. That seems very extreme to me.
Yeah.
Explanation number three would be that maybe small caps are actually going to be defensive in this cycle. That we're actually seeing is the same kind of speculative effect in terms of very narrow credit spreads, very big outperformance of the Magnificent Seven. Maybe everything else is going to be defensive. Now, it's always dangerous, as we started out by saying, this time it's different, right? Kiss of death.
That's right.
However, there is precedent for this. After the technology bubble, not only were small stocks defensive, but basically everything was defensive. And that's kind of our argument, and that's how our portfolios are positioned right now in kind of everything else other than the Magnificent Seven, because we think that's where the opportunity is.
Right, and back to the technology bubble of the late 90s, early 2000s, we're not talking about pets.com here, which has become sort of the moniker of, not such a great business idea, putting all your eggs in a basket that had really no fundamentals at all.
None.
Right.
None. No, this is a little bit different. But what people forget is during the tech bubble, there were real companies that took part in this. They were real companies with real cash flow, real balance sheets and everything else. And the downfall of the tech bubble didn't protect those technology companies. They suffered just as much. In fact, if you had bought the 6 largest technology companies at the peak of the technology bubble, and they were real companies, not a pets.com as you refer. No, they were serious companies. It took you between 5 and 20 years to break even. Just to break even. And they were real companies. So during that period where it was taking a long time for them to break even, if you had bought things like energy, if you had bought small caps, if you had bought emerging markets, you did fabulously well.
Well, again, a diversified portfolio.
Exactly.
For us at UBS, and I'm sure with you, you can agree, that is the way to protect yourself on the upsides, downsides, hedge your portfolio, make sure you're well diversified. Like you said, if you only had tech stocks in 1999, unless you got out at the right time, you were in big trouble.
Right. And I think now the notion of diversification is actually more painful because there are 7 stocks running away, but it's also about the easiest time in my career to be diversifying because all you have to do is be outside the 7 stocks. And so our argument is that universe of opportunity is historically broad and historically attractive, that we haven't seen anything like this in 20 or 25 years.
So here's the big question. This is where we've got investors watching, and they know you, and they say, all right, I want to hear what Rich has to say about this. If we're looking down the road, now, we can even skip past years here, whether the Fed cuts rates this year or not, or, even who wins or doesn't win this election. Looking let's look 5 years down the road a little bit. Where do you say, recommending anyway, for investors to be thinking about investing today that might have a little bit more of that short to medium term, some fundamental success?
Yeah, well, as we start looking out past, let's do something before the next commercial break time span.
Right, which is how we all live our lives.
Exactly. So, but if we really look at a 5 or 10 year time span right now, At RBA, we think the best long-term story is all about deglobalization. And this is kind of punching us in the face, and nobody seems to want to pay attention, right? We see this going on in the Middle East. We see it going on in our relationship with China, Eastern Europe, Africa, Latin America. This is happening all over the world. The deglobalization is taking effect. This comes at a point in time where the United States has a massive trade deficit. I mean, here's the way to think about our investment theme. Why does everybody understand the national security implications of the United States being dependent on the rest of the world for semiconductors, but they don't understand the national security implications of the United States being dependent on the rest of the world for everything?
Right.
For
Very good.
everything.
That's a fair point.
And so we think that the capital markets are going to be smart enough to allocate capital for the United States to reassert its economic independence. You can't be dependent on the rest of the world for everything as globalization is contracting. That's a very toxic combination. So we think this, you can call it the reindustrialization of America, nearshoring, onshoring, reshoring, infrastructure. It's all the same theme.
Yeah.
We think that's the big story for the next 5-10 years.
Yeah. Bonus question. What does Powell have to do here before we get to the end of this year?
I think he's probably going to do nothing. I think that
just sit down and stay quiet for a little while.
For several reasons. Number one, there's great uncertainty about the economy, and the Fed is clearly not a risk-taking institution. Number two, you have the election coming up. They don't want to be viewed as being political for one side or the other. Easier just to do nothing and just sit it out. And number three, I don't think they completely understand the inflationary forces of things like deglobalization that we talked about before.
Hopefully he'll watch this episode and maybe start thinking differently of his next
Maybe
meeting.
you will. Maybe you will.
Rich, thanks so much. It's always
Anthony,
great to have you. Thanks for all your insights. Appreciate you. And thanks for your partnership with UBS.
Absolutely. Thank
Rich
you.
Bernstein from RBA. Thanks, Rich. And for more information on everything coming out of our great partners like RBA and our own Chief Investment Office, visit our Insights website at ubs.com/views. Lots of great content up there for you. And don't forget to follow UBS on social media, particularly our dedicated Instagram page at UBS Trending. Give us a follow there. And as always, if you have any questions or want to continue this conversation, make sure you're reaching out to your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great day. And remember to keep your eyes on what's trending. We'll see you soon.